Hi. Let's learn about managerial accounting. Managerial accounting is all about providing financial information to managers within an organization to help them make informed business decisions. This includes identifying, measuring, analyzing, interpreting, and communicating financial data. Managerial accounting helps improve the quality of information delivered to management about business operation metrics. This includes information on the cost and sales revenue of goods and services, and it helps businesses identify and reduce unnecessary spending while maximizing profits. The key difference between managerial accounting and financial accounting is the intended users of the information. Managerial accounting assists internal users in making decisions, while financial accounting provides financial information to parties outside the organization and must conform to certain standards. Product costing involves determining the total costs involved in the production of a good or service. This includes identifying and assigning overhead costs and using margin analysis to make short-term economic decisions. Managerial accountants perform cash flow analysis to determine the cash impact of business decisions, implementing working capital management strategies to optimize cash flow and ensure the company has enough liquid assets to cover short-term obligations. Inventory turnover calculations help businesses make better decisions on pricing, manufacturing, marketing, and purchasing new inventory. This analysis can identify the carrying cost of inventory and efficiency improvements to reduce storage costs. Managerial accounting involves reviewing constraints within a production line or sales process to determine where bottlenecks occur and calculating the impact of these constraints on revenue, profit, and cash flow. Through balance sheet analysis, managerial accountants help management study the company's debt and equity mix to put leverage to its most optimal use, using performance measures such as return on equity, debt to equity, and return on invested capital. Managerial accountants use accounts receivable aging reports to categorize AR invoices and indicate to department managers if certain customers are becoming credit risks, in order to positively affect the company's bottom line. Budgets are used to express the company's plan of operation, and managerial accountants analyze performance reports to make appropriate changes going forward, utilizing capital budgeting metrics for decision-making, and reviewing the trend line for certain expenses. While they often perform similar tasks, financial accounting is focused on preparing and presenting official financial information for external use, while managerial accounting is used for internal purposes to make key business decisions. No, managerial accountants are not legally obligated to follow GAAP because the documents they produce are not regulated by GAAP, instead focusing on internal company metrics. Managerial accounting is useful for companies to track and craft spending budgets, reduce costs, project sales figures, and manage cash flows, among other tasks. Here are 5 key takeaways. 1. Managerial accounting involves the presentation of financial information for internal purposes to be used by management in making key business decisions. 2. Techniques used by managerial accountants are not dictated by accounting standards, unlike financial accounting. 3. The presentation of managerial accounting data can be modified to meet the specific needs of its end user. 4. Managerial accounting encompasses many facets of accounting, including product costing, budgeting, forecasting, and various financial analysis. 5. This differs from financial accounting, which produces and disseminates official financial statements for public consumption that conform to prevailing accounting standards. Hope this would help. Thanks for watching.